Good morning, students. As we are doing this chapter, the name of this chapter is Source of Business Finance. And as you know, there are different types of sources of business finance. Sources of generation finance is very much important, and what is the need of finance in the business you have understood. But we have a look again. Purpose and amount of finance required varies from time to time. A business may need funds to finance fixed capital or working capital needs. It may need finance for a short period or a long period. There are various sources through which an enterprise can raise finance, and selection of source largely depends upon the purpose and time period for which the finance is required. Each source of finance has a cost and a risk associated. Therefore, a business enterprise must compare the characteristics of various sources of finance available to select the best possible option. Students, as you know, in any business there are different type of requirement. Every business wants to develop his business more, and he and the business enterprise needs a lot of finance to meet daily requirements like expenses and purchasing the raw material, etc. For if he, if any business enterprise want to open a new branch at that time, it needs a business finance. If any business enterprise want to increase assets at that time, to purchase the asset, the business finance is required. There are different types of needs of a business. So we should understand how we can generate finance in our business. There are two ways. The first one is internal sources of finance, means within the organization, or second one is external sources of finance, means outside business organization. Students, we should understand what are the internal sources of business finance. The first one is retained earning. Business may not distribute all the profits earned. In the end of the financial year, any business organization see that it earn profit or suffers loss. So, if any business enterprise earns profit, profit is not consumed totally. Some part of that profit is retained. That is called retained earning as equity dividend to its shareholders, and that undistributable profit is called retained earning, and that profit earned as equity dividends to its shareholders. The profits left over after payment of taxes and dividends are kept as reserve to be used in the future. After earning the profit, company or organization pays all the taxes. After that, some part of that profit is retained for the future requirement. The undistributed profit are called retained earnings. Okay, so this is the internal source of our business. To make understand in depth, we should understand the features of retained earning. The first one is retained earning represent the undistributed profit, as we have discussed. they are important source of finance for business growth and development. Why that part of the profit is retained? For the development of the business. The answer: the amount of retained earning depends on the net profit earned, company's dividend policy, and the duration of the business. The fourth point is retained earning are part of shareholders' fund. Therefore, no external burden of interest payment or fixed annual returns of payment. Now, what are the merits of the retained earning as a source of finance having following advantages? The first one is it is the most dependable and permanent source of fund available at all time, because that retained earning is the part of our profit, so it is the permanent source of our business, and we will not able to pay that amount of interest, etc. Means there is no additional cost of raising finance. If we want to raise funds from outside, at that time we will have to pay some charges against that, but that is the part of our profit, so there is no need to pay additional charges. It does not involve any annual burden in the form of interest or dividend to be paid. Business has greater degree of operational freedom of and flexibility, no interference from outsider or delusion of control. And the next point is retained earning increase the capacity of business to meet unexpected losses. I think you have understood what are the merits of the retained earning. There are some limitations also. The first limitation is retaining profits for future business growth means lower profit being shared with the owners. When we cut a part of that profit to keep retained to retain for the future development, it means at that time we will share less profit to our shareholders. Low rate of dividends may lead to fall in the market price of share. When we will retain that profit, at that time our profit will be shown less, means at that time in the stock market our shares value may decrease. Profit of an enterprise fluctuate, making retained earning an uncertain source of fund. And the next point is the opportunity cost of retained earning is ignored. As a result, there is possible of funds not being used optimally. So students, I think you have understood in depth what is the meaning of retained earning. The next source, internal source of owner's fund is issue of share. Some enterprise or partnership business raise capital as investment from the owner's personal savings. This money remains invested in the business and owners get profit as rewards for investing money and carrying out business activities. Business established as private or public limited companies raise capital by issue of shares. Share capital. What is share capital? The total capital of a company is divided into small units called shares. The smallest unit is called as per value or face value of each share. There are different type of shares. First one is equity share and second one is preference share. Preference share. What is equity share? Equity share capital is the most important long-term source of finance provided by the owners of the company. They do not carry any preferential or special right against payment of dividends or payment of capital. Every company must issue equity shares at the time of its formation. What are the features of equity shares? All limited companies issue equity shares when they are formed. It is prerequisite to the formation of a company. The capital raised by issue of such shares is known as owner's capital. Equity shareholders are the owners of the company. Equity shares capital is an important and permanent source of finance, etc. There are a lot of features of the equity shares. Now, we will discuss the other type of preference, that is the preference share. Preference share capital. Preference share capital is the capital raised by the issue of preference shares. Preference shares are the shares which enjoy a fixed rate of return and get preferential or special priority while receiving payment for dividend or payment of capital at the time of liquidation. So students, I think you have understood what are the internal sources of finance. Internal sources of finance are retained earning by issuing of shares. First one is equity share capital and second one is preference share capital. In this way, internal sources of finance you have understood, and by selling goods we can arrange the internal source of finance and we can ask for the debtors to give the payments in this way. And the second one is external source of finance is trade credits. Trade credit means credit extended to a business by its suppliers. It is the facility to purchase inventories or services without making immediate payment. We have discussed the previous uh, external source of finance are trade credit, internal corporate deposit, ICD. What is ICD? Internal corporate deposits are the unsecured short-term deposit made by one company with another company. These deposits are made by corporate having surplus funds to the cash starved corporate. And other is factoring, next lease financing and the public deposits, commercial paper, that is called CP. If you want to understand what is CP, commercial paper is an unsecured promissory note issued by a firm having good credit worthiness to raise funds for a short period. At that time the company issue CP, that is commercial paper, varying from 7 days to 364 days only. And debenture is a long term borrowed fund. In this way, students, we can say there are two main sources of generating finance. First one is internal sources and second one is external sources of finance. So student, we will discuss some other points in the next chapter, that is internal financing. We will discuss what is internal financing. Till then, stay home, stay safe.